Happy Friday, traders. It's 8:02 a.m. here in Chicago on Friday, the 3rd of April, 2020. Thanks for joining me for another Trader Bite, episode number 1727, brought to you by edgeclear.com. Derivatives trading involves substantial risk of loss is not suitable for all investors. Past performance is not necessarily indicative of future results. This morning, we have pretty much just another mixed bag coming in. Technically, the equity indices, the equity indices are just slightly down across the board, with crude huge up. Crude had a massive 32% range day relative to the low yesterday. Adjust the volume relative to the low yesterday, and is trading up another 10% today, up $2.622.62 on the May crude oil WTI crude contract. It's at 27.94, up 10.35%. This is on news following POTUS having a conversation with Saudi Arabia and Russia to curb supply and to stabilize crude prices. Now, here's the thing, you know, it's politics in action. If oil prices are so historically low, going back to 1991 or something like that, if they're so historically low, isn't that good for the citizens? Isn't that good for business? But here's the president coordinating with Saudi Arabia and Russia to bring prices back up to support the oil industry. So, you know, good for the minority, not so great for the majority. But anyway, my opinions aside, that's what's happening. He announced that there may be a 10 million barrel per day cut, but the likelihood of that happening is extremely non-existent because Russia will not cut production unless everybody else cuts production, including the shale companies in the United States who are already getting killed, and cutting production means less money in their pocket, and yada yada. And it just goes on and on. And there's also some demand destruction, demand destruction for crude anyway. So this pop up, I mean, we know that crude at $19 is pretty cheap, in my opinion, pretty easy, pretty straightforward expectation that it's likely to pop up after dropping on a pullback. Sorry, I have to drink my tea because my throat's kind of dry. But to um, um, but to have it break higher is at this level, to have it go shoot up this high, of course, two impulsive moves in a row is an interesting thing. In any case, I'm not an expert on crude, but to me, that's what's going on. I find it kind of ironic that the president of the U.S. is intervening there. In any case, the rest of the market looks like, the yen, the pound, and the euro are down, with the U.S. dollar stronger this morning. The U.S. dollar is over 100, trading at 100.91, up 64 cents on the June contract, and the S&P is down a tick. The Nasdaq's down 7.75 points. Gold is down $2.10 to hovering around 1635, and so on and so forth. To me, this is coming into Friday as a mixed bag, and as you probably already know, non-farm payrolls were due today. Non-farm payrolls were expected to be down 150,000, came in down 701,000. The unemployment rate was expected to jump up from 3.5% prior to 3.8%. The unemployment rate jumped a historical amount, 4.4%, 0.9% from prior. uh, in 1 month. This is, of course, unprecedented, but so is the current situation. Ahead, we have market composite PMI, 15 minutes after the open, expecting 40.5. And then at 10 o'clock, we have ISM non-manufacturing expecting 45. And then, yeah, expecting 43 actually. And that wraps up the day. Baker Hughes rig count at 1 p.m. But that pretty much wraps up the day and the week uh, in terms of the calendar. In terms of what was expected yesterday, I was looking for, we were opening on the edge of the prior day, which was a neutral extreme down. I was looking for responsive buying into the 2458, 2460 area. And then I was looking for the market to then fail lower and head towards that big 2400 for 2400. That did not happen. The other scenario, the secondary scenario, was for the market to push that low, and that's because of the way the overnight session was set up. The overnight session had a big trend down with a weak low. Expectation was we take out that 24.75 and then turn up and start moving towards the 24.74, 24.80 area. Here's what actually happened. It did not. It did not go down at all. We did not open it. It ended up running up a little bit before the open. It was trading on the edge of 24.33 or so, and it became responsive off the open. And we pushed straight up and took out that 25.0975 high and traded in range for most of the session to close relatively strong. We did not have a neutral day yesterday. We had an up day on what's called a normal variation day, and closed pretty strong actually. The delta into the close was fairly positive, and delta was moving with price yesterday. We're likely to see the market is finding a base around the 2500, and then is likely to continue to drift into this low volume node and continue to fill this big gap zone we left behind on Wednesday. And we're likely to continue to fill that low volume node and push up towards that 2570 area above. This is how things are setting up. Here's what happened overnight on that number. Overnight was pretty much all a downward drift from the Asian Open onwards. Stabilized a little bit when the Europeans came in. Here's where Europe opened, stabilized a little bit, held sideways, and built this very, very odd shaped profile. We have a very boxy profile overnight. Very boxy profile overnight, and we were holding steady under the mid. You could see a nice test of the mid here, holding for a small attempt at a continuation lower, which did not occur. A higher low here, and then it started to drift up before the non-farm payrolls. Here's what non-farm payrolls did, surprisingly, right? With a number that's so terribly off from where it was supposed to be, it sure spiked up pretty good, and pushed higher instead. So what we did is we spiked up, we spiked down, we spiked lower, spiked up before, and then spiked lower after, and we're holding steady in the middle of the market. Not sure what's causing this. The market is must have expected a worse number, which is what I'd heard someone comment. But then if it expected a worse number, why was the forecast only for a negative 150,000? That makes no sense. If the market expected worse, it's like a week ago Thursday, when we got 3.283 million initial claims, and the market just rallied off that number and continued to rally on the open. And the explanation from the pundits on TV was, well, the market expected worse. Well, if the market was expecting worse and was pricing worse in, why wasn't the forecast for 3 million initial claims? That makes no sense to me. So I don't know what to make of this behavior, and I'll show you the order flow and the way this looked as it was trading. Uh, because of the way it was trading, but I'm not sure if the market's expecting further stimulus. I'm guessing the market has see this as a good reason for politicians to create further stimulus. Um, yeah, further stimulus for the poor jobs market that we're in currently, and that's what the market's responding to. Here's the order flow this morning. Let me scroll this back. So you could see, where are we going here? Very laggy. So we could see that the market had a nice run up right in here, a nice run up, spike up to 25.25, 25.26.75, and then it drops on the non-farm payrolls number. It just ran way up, and then it spiked down a little bit on the non-farm payrolls number, comes back almost to where it was before the number, and then is consolidating sideways. Completely noisy trade. The book, however, has had some pretty steady liquidity pools in it. Pretty steady liquidity pools in it. Um, that the market has traded against in the overnight session. I expect the auction today to be quite orderly, in fact. But if you look at how it ran this, we had a parabolic move up right before the number. This is Chicago time here. 7:30 is the non-farm payrolls right there, and you can see this parabolic move straight up and a correction straight down, and then you have the number, which really didn't have much movement. The number had very little movement. It's as if the market already knew what the number was going to be. Surprise, surprise. And then we have this impulsive move up, continuation move, and then we have a corrective structure here, and now we're just going sideways and just chopping around. I expect the open I expect the open to uh, be quite active. And if we look above and below, we see these liquidity prices, liquidity zones that have been fairly steady for the session down below. 2480 is pretty well bid, has been well bid for the entire session. 24.75 below there, above 25.25, but that came in after the high was put in, so it's suspect. And then above there, 25.30 has been steady, even when, and you could see this is what I look for in the order flow is price moving up, and then we see liquidity get brighter and brighter, and the more the scale goes to the right, the more liquidity there is. And this tells me that this offer up here is likely to trade out. And then, so that's where it stands. So the market is really pricing in some treasury crack or some Fed crack, and that's what it's responding to. Remember, this market does not run on earnings as it was supposed to, as it had before 2008. It runs on whatever the Fed can do to inject money into it, so we can buy back stocks and inflate prices artificially using cheap money. That's where we stand as an economy, it seems. Anyway, enough editorializing. Let's get back to the facts. The last 2 days, here, as we move into the current situation, we've got what looks like balance over the 2 days. So let's draw a profile around that. I believe the MCV POC's around 24,693. And you could see over the last 2 days, these two the two profiles come together to form this quite bulky profile altogether. And so it is it's not cynical. It's seeing the same thing for the last 12, 13 years. But here's the profile. Look at how fat this profile is for the last 2 days. Quite balanced, and it's the market's basically in a holding pattern and sitting sideways. And overall, it looks like it is really uh, gearing up to push higher. We did have that neutral extreme down day the other day, and a big tell yesterday was it ended up reversing that move, and it shows that buyers do have an appetite at these prices, and we are likely to squeeze higher. I'm not sure how much of that we'll get today, but the expectation this morning is we have an open auction. We're likely to have an open auction in value in range. We're opening up against the point of control yesterday, so expecting some chop given the way the liquidity is set up in the markets. Remember, 24.81 down below, or 80 is down below is well bid. 25.25 and 25.30 well offered. I'm expecting the market to open sideways, test lower, consolidate for a little bit, and then I'm looking for it to start squeezing up and pushing into this gap zone area that we still have, this gap zone that we've left behind, of which we filled a portion, about a third yesterday. I'm expecting the market to squeeze into that low volume node and to start pushing higher before balancing out for the weekend. The weekend, of course, a protective position is likely to be taken by the higher time frame as news keeps flowing on this COVID situation, and with all the activity that's going on in um, the money market and so on. They're likely to roll over a little bit. The secondary scenario is we do push up early on. We squeeze into that new high. We push into the gap zone. The gap zone mid here is right at the 25.34 and a quarter, 25.34 and a quarter. Push into that gap zone up there, and then come back down and consolidate for a third day and finish sideways in this area to set us up for a Monday that's likely to be to move away from this area. A balance is likely to lead to imbalance. The market tends to trade a small set of prices for a while. People take positions people take positions to form this fat profile like we see over here to the left, and then one side or the other is likely to be wrong. And because they have interacted quite a bit to form that fat profile, that becomes fuel, the stops from the people who are wrong, whether long or short. That becomes the fuel that feeds that feeds the next move, and that's what I'm looking for. I'm looking for this gap zone actually to be filled. It looks like the market is stabilizing and is looking for higher prices. Another indication of that is the fact that the VIX keeps dropping, and so there isn't as much insurance being bought at higher premiums in the option market. So the general expectation is it's likely to kind of cause a drift higher. There is a third scenario here in that it may be a 2-day rest after the gap down, which is kind of an impulsive move, which then brings in an open that pushes up and then drives down, gets below yesterday's value, which is valid, and then starts to move lower. And again, we have that 2420 and 2400 in range. Not very likely, but very possible that we have 2 days of balance. We test above, we're not able to find any follow through, and then this higher non-farm payroll problem starts getting digested, and the market just kind of sells off, rolls over and sells off into the 2400, which is a big magnet in this area. It's a big attraction down there. That's what I have for you for today. Remember, it's Friday. Come into the weekend with a clear conscience rather than one that is tortured by the fact that we got emotional and we overtraded and then we gave away a lot of our account to the market. Trade conservatively today, and just just follow your plan. There's no sense in betting bigger than you have to on any particular trade. One trade is just a drop in a bucket in your trading career. Good luck, and I'll catch you on Monday. Take care.